Before we get there, we've got 2 more CPI prints, 2 more job reports. Is it too early to expect some weakness to show up in those payrolls reports before we get to September?
I think weakening is certainly possible. But, when the 3-month average of payroll growth is 375,000, to expect a negative number before the September print, I think, would be kind of an unprecedented slowdown. So I do think we should see things slowing. Certainly the jobless claim numbers would suggest that. Surveys would suggest that. But I don't think we'll be convinced of recession by the time we get to the September FOMC meeting.
At the same data today, how does the Fed view this? This is what they want to do, right? They want to tighten financial conditions, but it seems like it's a really bifurcated tightening with a lot of conditions, i.e. the stock market doing okay, whereas other areas like the housing market, where the rank and file individual is trying to buy, is a little bit more tenuous. Is this a good thing for the Fed?
Well, it's a normal thing. I mean, when you tighten policy, interest-sensitive sectors get hit the hardest. The one that gets hit the hardest and the most reliably is the housing market. So that's doing what it should be doing. There's a lot of other parts of the economy that are much more unusual in their behavior right now. Some of that due to the lingering effects of the pandemic, the recovery of the service sector. But I think the housing market is, I think the Fed is probably happy with the slowing that they're seeing there. And I suspect we'll start to see some slowing in manufacturing just given the strength of the dollar. And again, that's another normal effect. That's another interest-sensitive sector.
Yeah.
But a lot of other things aren't behaving as normally as they would in a business
That's
cycle.
the objective. You said it. Mike Ferrari. Mike, going to be sticking with us going into this decision. Priya Misra is going to join us shortly as well. Lisa, we've said that a few times. The objective was to take some heat out of the housing market, to take some heat out of the labour market, and arguably we're seeing that.
The problem is you're not seeing it really take heat out of the headline CPI number, at least not yet, with peak inflation getting missed and actually seeing yet another peak inflation. So
Sure.
How do they talk about the transmission mechanism of tightening these financial conditions into an inflationary outlook that's really driven by the supply as much as demand?
Yeah, I have to say, monitoring the tone of the conversation over the last month or so, Tom, coming into this meeting, would you have guessed that inflation had a 9 handle?
No.
I would say no. And if you go to the last statement and go to the third paragraph, the last line, the committee is strongly committed to returning inflation to its 2% objective. Given it had a 9 handle last time around, Tom, shouldn't that be the singular thing that shapes the news conference today?
I think the zeitgeist, John, is we're already moving in that direction, 987. My question is, how do we go 7, 6, 5? I'd also note, John, the real yield, it's a property of yours on Friday afternoon, 0.38%, and the real yield. We're not getting back anywhere near a normal nominal and real vista, if you will, that would seem to be normal.
Even for those that think the Fed should pause, maybe even pivot, Lisa, even those people, Ian Shepherdson and Pantheon for one, who's expected a wall of economic data to weaken over the coming months, he says today's too early. Wait until September.
And part of the reason why is because if they give a message that they will pause next year, what does that do to markets? It basically gives them a green light to keep rallying if you're at risk and even potentially keep rallying if you're duration. So this just goes right back to where we were before. And
raise rates more.
Factor.
That's exactly the argument that Bill Ackman put out on Twitter in the last 24 hours. There is a guest coming up shortly that Tom Keene is super excited.
Was muss passieren, damit sich ein potenzieller Kunde für dich entscheidet? Wenn du ein gutes
to speak to.
Yeah,
It's Priya Misra of TD.
Guest of the day.
Priya came on and we had some slight inversion of the yield curve. She was looking for negative 40. We're only 10 basis points away now, Tom, at negative 30.
It's just a superb call of the year. It's absolutely just outstanding call.
Looking forward to catching up with Priya Misra of TD very, very shortly. We are less than 30 minutes to go. We have about 17 minutes and 29 seconds until we get the Fed decision. There you go, Tom, just for you. Live from New York City, this is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We have the Fed meeting. There's not much of a surprise with respect to what the Fed is going to do.
It's either 75 or 100.
They had the opportunity several weeks ago to go the 100 basis point option, but they quickly swatted that one away.
75 basis point hike is more than priced.
If I take Chair Powell seriously,
the Fed clearly has to fight inflation.
Whatever it takes to bring inflation down.
Some of this is messaging.
Whether they like it or not, whether markets like it or not.
Jerome Powell has made that very clear.
What is going to be far more interesting is what Powell says about what the future path of rates looks like.
Key focus, I think, is going to be on the signaling for the upcoming meetings.
Less forward guidance or more uncertainty.
We're not expecting big forward guidance from the Fed.
We are 15 minutes away from that Fed decision, and here is your price action in the equity market. Good afternoon to you. The S&P 500 positive by 1.3%. The Nasdaq 100 positive by 2.6%. The bottom for the year intraday, the day after on the Nasdaq, after the last Fed meeting. Just think about that. The day after the last Fed meeting. In the bond market, the highs on 2s and 10s the day before the last Fed meeting. So since then, we've been talking about peak Fed hawkishness. We've been fading a lot of that story, and we've been buying into this equity market. Yields on a 10-year now, 276.48. The high of the year, very close to 350. The high of the year on a 2-year, 345. We've come all the way back in, just north of 3%. But we've done much more work on the 10-year. So you've got that inversion led by that drop in a 10-year yield. That's now negative 30 basis points. And our guest in just a moment is looking for maybe negative 40 and a whole lot more. Wanted to check in on euro dollar. The why pretty clear, because the last time the ECB met, they threw in the towel on forward guidance. Euro dollar 101.29. And I wondered, Tom, what that means for the forward guidance from this Fed today as they set us up for September.
John, it's outside baseball, but dollar yen, I want to note, is weaker across the morning, across the arc of the day as well. Yen gave way about 3 hours ago.
TK, the cameraman, has walked away from me, so I'm going to walk away from you as well.
Okay, well, that happens because, it's the afternoon and the morning, and we're like, we're doing a Fed meeting here with some terrific guests. I'm not going to go into the logarithm right now of how you do this chart, but all you need to know is Priya Misra may have the chart of the year. It is the first and second derivative of curve inversion. Priya, we've seen it once, maybe twice in 30 years. Let's start with the why. Why are we seeing the rapidity of curve inversion in 2022?
Thanks for having me. I think it's because the market is pricing in slowing of growth. And the Fed, that's indicating that inflation is much too high, and they have a single mandate right now. And so I think that front end is just going to struggle to price in a lot of cuts. There's a different threshold for the Fed to stop hiking and to start cutting. And so I think that even if we start pricing in the end of the hiking cycle at 3.75 or 4%, as we believe, right, it's hard to think that the Fed is going to turn around and cut right away. But the long end, that's the safest part out there, because I think growth is going to slow down. Those real rates are very high. And that's where I think investors are flocking, because we're seeing growth slowing down, and this Fed, I think, is responding to realized inflation. And I think that's the issue right now, where the curve will keep inverting in our view.
What does a Misra curve inversion of negative 42 basis points mean to the Toronto Dominion Bank, to the JP Morgan, Michael Feroli's JP Morgan? What does that magnitude of inversion mean to our banks?
So I'm not a bank analyst, but normally inversions are a signal of slowing economic activity in the long end. Over time, it's a function that Fed policy might be too restrictive, and that can slow things down. So, I mean, I think it has broader economic implications, certainly negative for financials, because does it mean that the consumer starts to struggle? I think that's what it's reflecting. But the Fed has no choice, really, because inflation is much too high, and they've decided to be not forecast dependent, so they can't actually talk about lags. Because, I think they can't control large parts of inflation, and there are lags in terms of what they do today and when it impacts inflation. But they're responding to realized inflation, and that's why they're going to keep going, and that curve keeps inverting. And I think that means it's a dire economic outlook next year.
Priya, is forward guidance dead when it comes to the Fed as well?
I think so. I think we're so used to it. I think the Fed can't help themselves either. I wish they would just acknowledge that there is no forward guidance. There's an inherent contradiction between being data dependent and giving forward guidance. So I think they should stop giving it. But let just explain the reaction function, and then let the data do the work. Let the market move based on data. Everyone's asking us, will the Fed pivot today? Let the data pivot for the Fed. When inflation starts to decelerate on a month-over-month basis, I think the Fed can slow down. They've reached neutral, so I do think they're going to start to slow down. But I don't think the end of the hiking cycle is near, because those inflation readings are still much too high. I wish they wouldn't talk about September, because whatever they say, there's a lot of data between now and September, and I think it's kind of pointless to give us that guidance.
Okay.
But
perhaps that's the case, Priya, but they might want to push back against some of the market expectations, because it's actually ending up with an easing kind of quality on markets. And I do wonder about all the prognosticators now talking about the Fed stopping the balance sheet roll-off and actually sticking with the $9 trillion on their books as soon as next year, early next year, as a way to sort of temper some of the rate hiking. Do you agree?
No. So I think this is where that threshold question of the reaction function becomes important. They can stop hiking at 4%. We think close to year end, they stop the hiking cycle. And then they wait for inflation to get much closer to 2%, which we only think happens in the second half, before they can respond by easing policy. When they do start to cut rates, I think they're going to stop QT, because it's very hard to be tightening through one tool, the balance sheet, and easing through the other tool. But that's not early next year. I really struggle with the market that's pricing in hikes until December and cuts from February. I mean, that assumes that inflation decelerates or the Fed gives up on inflation. I think they're serious about both sides of the mandate, more so inflation right now.
Priya Misra and Michael Feroli with us on radio and television worldwide. A most important and indeed historic Fed meeting, 9 minutes away, make it 8 minutes away here in a bit to that announcement. Michael Feroli, I want to talk to you about the agony of this politically. Jerome Powell is a political beast. I was lecturing on that, I think it was last night. He has a political audience. How does he parse a growth recession, 0 to 1.x% versus a real recession? How does he do that politically in this press conference?
Well, I think what's been really unusual about this year is the way that both sides of the aisle have supported tighter monetary policy and supported aggressive anti-inflation policies. That, when you look back historically, is pretty unusual. So he's almost got a free pass this year to go aggressively like they did last meeting, like they're going to do in a couple minutes. Going forward, if we do actually genuinely have contraction in employment, that will be a trickier situation.
Adidas, Ray-Ban, Gucci, Dutzende Modekonzerne investieren aktuell aggressiv.
Fortunately for Chair Powell, he has another 3 years on his term, but that's when things get interesting. But I do think we shouldn't lose sight of the fact that, he's basically got a political green light to be pretty aggressive this year, and that's going to continue until we see employment contract.
Michael Feroli, at this moment, using this fancy pants word from Booth School Chicago, are we unanchored?
I don't think so. So if we're talking about inflation expectations, the measures we see, certainly the market-based measures, the market is, to Priya's earlier point, convinced that, or not convinced, but seems to be aligned with the view that the Fed will get things under control. And even if you look at, somewhat surprisingly, the survey-based measures are actually came down quite nicely in the most recent meeting. So I think fears about being unanchored right now don't, to me, that doesn't ring true.
So perhaps that's not ringing true just yet to you as well as the rest of the market. But Priya, I'd love you to come in on this. There seems to be this belief that the Fed will not have to stay at a very high rate for a very long time. Do you think that that's going to be what's required, a la Alan Ruskin of Deutsche Bank, in order to get inflation under control, in order to get the long end where you see it as you go and you buy 30-year bonds?
I think so. I think, there's parts of inflation that can come off, headline inflation. There's other parts like shelter that tend to be a lot more persistent. There are lags between home prices and rents and shelter inflation. And those lags will keep core inflation high. And so this idea that the Fed can pivot and go from hiking, to cutting quickly will require inflation to suddenly decelerate. And there are parts of inflation that I think are not transitory at all. And that will require the Fed to stay there. And that's when I think we'll all fret about the economy. But the Fed will say we've got a dual mandate and inflation is much too high. So we expect them to stay at these uncomfortably restrictive rate levels and QT for much of next year until inflation comes down and allows them that policy space to start to cut rates.
And Michael Ferroli, there's a question embedded in that, which is what metrics the Fed will be looking at to know that they can reach an all clear, where they can start taking their foot off of the brakes of the economy. Is it inflation rate that falls down to 5%, 4%, or is it just an economic downturn that is severe enough that needs their support? What's your view on that?
I mean, clearly inflation numbers are going to be first and foremost. I think we can look at them on a sequential basis. It doesn't have to be on a year-ago basis. I do think they might be a little bit forward-looking as well. I mean, they haven't been forward-looking so far in this cycle. But I think if we see wages and wage growth really come off in a big way, that, particularly if that happens in the midst of a recession, I think that would be a signal that some of the wage price spiral concerns would be easing. So I do think some of these supplementary measures will also come into focus.
Dr. Ferroli, a question in honor of the great Alan Meltzer. He once tore me to shreds and told me you can't partition monetary analysis. You have to look in the aggregate. Are we executing Fed policy for all of this nation or for one part of two Americas?
I think it's for all of this nation. I mean, certainly the price measures that we look at aren't disaggregated among buckets of consumption patterns. So some people would, certainly during QE periods when, criticize the Fed for setting policy for one aggregate, but that's,
right.
They only have the tools really to affect the aggregate and not to affect sectoral composition.
Michael, Priya Misra's adamant we should not mention September, so let's do that right now. And with you, Michael Ferroli, suggest what is the ghost or the shadow that September places upon this meeting? So
I guess one thing I would say is, last couple of meetings, Chair Powell gave pretty explicit meeting ahead guidance and quantitative guidance. I think he may stay away from that in this meeting because, as John mentioned earlier, we do get two sets of payrolls, we get two sets of CPIs. So a lot could change between now and September. I don't think the chair wants to be that definitive on what to look for in September. That said, I think unlike Europe, unlike the ECB, we will have some forward guidance in the statement and that it will continue to indicate that further increases are, what's in the committee's mind right now.
Mike Ferroli, awesome to catch up with you, sir. As always, from JP Morgan to Priya Misra of TD, thank you to you as well. Tom, two things here. Lisa's mentioned this a few times over the last week. It's going to be really difficult to acknowledge the weakness in the economy that's emerging without implying that we're about to slow down rate hikes at a time when inflation still has a 9 handle.
Well, yeah.
That's going to be really, really difficult to do. Point one. Point two, to Mike Ferroli's point on forward guidance, Tom, what forward guidance can they offer today when they've got two more prints on CPI, two more prints on the labour market? That's difficult to do.
I mean, you're setting me up with this, John. I don't know.
Well, I think we've got Jackson Hole as well. There's plenty of opportunities to offer some guidance into September with a bit more data behind it.
With more data. They are massively data dependent, and this goes to ex ante, ex post, and the answer is all central banks, particularly Christine Lagarde with the challenges of war and what Nat Gas has done in the Netherlands, what you've chronicled, John, here in the last number of days. And differently, Jerome Powell, I'm sorry, they're massively, massively ex post right now. They're slaves to the data.
And they're explicit, Lisa, about getting back to 2. And at the moment, we're at 9.
Yeah.
You've got to remember that going into this news conference, into this statement 2 minutes away, we're at 9%. And we've just had a pretty hot inflation report that should shape this decision?
They have a long way to go, and it's only getting further away if you take a look at where we were in the last print. There are two debates here, and perhaps the most instructive thing that I'm looking for from Fed Chair Jay Powell today is the balance of risks. Is it a greater risk of inflation expectations becoming unmoored, or a greater risk of a recession so deep that it will be difficult to climb out of? So far, it has been inflation becoming unmoored. When does that rhetoric shift as we start to see some of the weakening in the data?
John, I'm not publishing this afternoon, but let me go three-part on you. There's 9% down to, say, 7, and then there's 7% down to whatever, 5 or 4. How do we get, John, after all we've been through, from 4.8% down to 2.x%? What is the debate going to be, John, in a number of years, maybe 5 quarters? What's the debate going to be about 2 or 2.5 or 3? That's going to be extraordinary.
Well, Tom, I think that's the point that Alan Ruskin is making over at Deutsche Bank, that if they pause anytime soon, they could be staying there for quite a while, TK. They could be there for quite a while. This idea we transition straight into cuts, I've heard a lot of people push back against that this week.
Yeah, just, and this is off topic here, but I'm going to go there, John. No one's modeling stronger dollar. They're modeling resilient dollar. What if we get stronger dollar, particularly given the Lupton-Kasman note that they just published at J.P. Morgan?
Well, I can tell you some corporations, Bramo, they might not be modeling it, they're fearing it.
They're living
at the moment based on the earnings, and to Tom's point, they're living it.
Yeah, billions of dollars of lost revenues as a result of the strong dollar. At what point does that become a headwind to growth? At what point does that become a problem for the Fed? It's too soon, but it seems like the
Du bist dir nicht sicher, ob wir dir wirklich weiterhelfen können? Dann lass mich dir verraten, wer unser Traumkunde ist. Du bist unser Traumkunde.
Dollar versus what? Is this a euro story or is this a dollar story?
We are about 30 seconds away from that Fed decision. Let me guide you through the markets going into that. We'll start with the equity board. We've got a lift, a rally going into this Fed decision. Equities up by 1.3% on the S&P 500, up by 2.7% on the Nasdaq 100. The bond market shaping up as follows. Yields on a 10-year lower by 6 basis points, on a 2-year unchanged. That curve inversion there for all to see as we go into this decision, looking for something like 75 basis points with the decision down in D.C. Here's Mike McKee.
Well, status quo pretty much as expected. The committee raises the target range for the federal funds rate to between 2.25% and 2.5%, 75 basis points, and says that they anticipate, quote, that ongoing increases in the target range will be appropriate. There are very few changes in the statement. The only one of substance is an acknowledgement that, quote, recent indicators of spending and production have softened. Nevertheless, job gains have been robust. Inflation remains elevated, which they blame on the pandemic, broad price pressures, and higher food and energy prices. And of course, Russia's war on Ukraine, which the committee says is, quote, creating additional upward pressure on inflation and weighing on global economic activity. As they said in their last statement, the committee emphasizes they are, quote, highly attentive to inflation risks and, quote, strongly committed to returning inflation to its 2% target. As for QT, the committee reaffirmed its plans to raise the caps on roll-off of MBS and Treasury securities to $95 billion in September as planned. The vote was unanimous. Esther George did not dissent. Michael Barr and Susan Collins casting their first votes on the committee with the majority. Guys?
Michael McKee, you are going to be in the press conference. We know you're going to get the last question. They're so afraid of you. So let me avoid the question and ask you simply, what does he not want to say about September's meeting?
He does not want to say how much they're going to raise rates. I think he will because the committee statement says they anticipate further rate increases. I think he'll endorse that. But he won't want to say by how much because they're going to want to see what happens with the numbers between now and then. We get GDP tomorrow. We'll see how growth is going. And then you've got a couple of CPI reports and a PCE inflation report and 2 jobs numbers before the next meeting. It's an unusually long period of 7 weeks. So a lot of data that could change a lot of minds, and it wouldn't do the markets any good to get whipsawed.
Hey, Mike, awesome to catch up with you, buddy. As always, Mike McKee down in Washington getting ready to go into that news conference. 75 basis point hike. We anticipated that. Lisa, we asked about how you would acknowledge the weakness. This is how they do it. It's in the first line of the statement. Recent indicators of spending and production have softened. Then you add this. Nonetheless, job gains have been robust in recent months, and that's what they're pointed to. That's where the resilience is, the strength at the moment at least. Lisa, we're seeing just maybe the smallest of cracks in the last 3 weeks with claims starting to pick up. But that's a nod to the payrolls growth we've had over the last few months.
And it reiterates what Janet Yellen was saying, the Treasury Secretary, where she was really emphasizing that strong labor market. How much are they going to use that as the reason to keep going? And at what point does this actually mean if we start to see real softening? We'll have a different conversation at the Federal Reserve.
And no big change in this equity market off the back of it. We're still positive by 1.5% on the S&P, on the Nasdaq up by 2.6%. If you look at bond yields, basically where we were, down about 5 or 6 basis points on a 10-year to 275.21. Pleased to say that joining us now is Mohammed Al-Arian, Bloomberg opinion contributor and chief economic advisor over at Allianz. Mohammed, you've had a few minutes to digest this. Your response, please.
Exactly as expected. The statement was very much what the market was looking for, and that's why the market reaction has been muted. The press conference, John, is going to be absolutely key, because I suspect that Chair Powell will be pushed on guidance, and that's where things get really tricky quickly.
How do you expect he's going to navigate that, Mohammed, given that we've got 2 more CPI prints, 2 more payrolls prints, and a Jackson Hole before we get to September?
I know how I would navigate it, or suggest to him to navigate. I don't know what he'll do. Is don't be specific. Just keep it general. There's a lot of uncertainty ahead of you. As you point out, we have many data points. We have a major confab coming up at the end of August. Just keep your options open. That's what he should do. But in the past, he has been...
واش غنقول لكم الاخوان. المهم عشنا اللحظه لايف اونسومبل. نتمنى عجبكم هذا اللايف اللي كان سبونطاني. المهم زاد 0.75%. المهم كلشي زوين دابا، راه كيف تشوفوا الشاط راه كلشي الخضر في الخضر، ولكن هما بداو تينزلوا عاوتاني. شتي كلشي دابا غيتفائل، غيصحابهم دابا بان يعني كلشي البيتكوين غادي يطلع دابا ل 30,000 40,000. هما بداو تيهبطوا عليهم السوق، ولكن غادي يهبط عاوتاني وغادي يطلعوا عاوتاني. المهم كنشكر جميع الاخوات والاخوان اللي حضروا معنا اليوم هذا اللايف. كنقول لكم شكرا بزاف على الحضور، شكرا بزاف على الدعم ديالكم. ايوا وكنضرب لكم حلقه ان شاء الله. حلقني كنضرب لكم موعد في الحلقه المقبله ان شاء الله. ان شاء الله نديروا المره الجايه لايف وكل شيء يعني يطرح الاسئله ديالو. ان شاء الله غادي نديروها. تبارك الله. شكرا للاخ يوسف كوهين، حس اطلس. شكون كاين معنا؟ اكس ار اكس هذاك مشى. وشكون معنا؟ عز الدين وصال، كريم كرم، كاين ديو كان. كلشي كاع الدراري والدريات اللي حضروا معنا هذا اللايف تنقول لكم شكرا بزاف. ومساء الخير. اللي باقي ما تفرجش في الفيديو ديال اليوم يمشي يتفرج فيه، راه حطيناه. نتمنى انه يعجبكم. وتبارك الله عليكم، وتا المره الجايه ان شاء الله. السلام. عمر السعيد. شنو خضور؟ شتي الخضور يا ابو سعيد؟ انت بنتي لي يلاه فقتي في برلين. يلاه طفات عليك الشمعة. الجيمر امين وانا تا انت مرحبا بك. جيمر امين الله يحفظكم. نشكر كل اللي نسيت ما ذكرت سميتو يسمح ليا. حيت هذا اللايف هذا كاع ما كان والله ما كان بلاني داكشي علاش. المهم كنشكركم كاملين وتنقول لكم السلام عليكم حتى المره الجايه ان شاء الله. يلا دائما ديما تبع الحمار ما تبعش الخضر. يلا السلام عليكم.